Hey, good morning, everyone.
Good morning, Professor.
Good
Hey, good
morning.
morning, Ian, Kazuki, and Randy. Good morning. All right, I see 7 people. And I see 9 people in the today's forum. 10. So we're still missing 3 people. Um, I have 8 people, so missing 2 people still. Just hope these people will join us shortly. All righty. So today we're moving on to the new topic, the second topic, right? Oops, not this one. What's going on here? So, course materials. All righty. So we are moving into uh, financial statements. Uh, so it was supposed to be, actually, um, we were supposed to have finished everything, the topic one, everything of topic one by the 5th. But even, we barely got to this, barely, were able to finish it by the 7th. So we're kind of, like 2 days behind. Um, so if you go into the topic 2 folder, right, of course you got to download these 2 files, right? They have been made available. Always all the lecture videos, main lecture videos, are made available one day in advance. I mean, if it involves weekend, like, still one day in advance or 2 days in advance, or even 3 days in advance, depending on. I mean, something that is scheduled for Monday is normally made available either on Friday or Saturday or Sunday. So they have been available already since, I believe, they have been available since Sunday. Let me just make sure. Oh, it was available since the 5th already. And then the main lecture videos, they were available since when? Still, from the 5th, since the 5th. Okay. Well, you should be able to, since they are always posted for 5 days. Actually, today is the last day, I believe, for these first 6 videos. Was it first 7 videos? So let me. So that was supposed to be one day advance. So in advance. So this was. It must have been scheduled for the 6th. Yeah. So it is available. Intro 1 through intro 6. These videos are available until the 11th, which is tomorrow, right? All right. So I have to operate um, based on the assumption that you have studied um, the main lecture videos as in advance. Okay, Ian, you mean quiz one? If you, I mean, uh, okay. Anyway, now that I found it, I will answer. But normally, if you put questions in the chat box, um, I cannot timely discover it because I'm most of the times, I'm not in the, I cannot see the chat box simultaneously. So anyway, it will be it's better to um ask questions that are outside the contents of the scheduled contents of the day. If the question is about the contents that's outside the scheduled contents of the day, then it's best to ask by email. Um, but since I discovered it, it's going to be every topic one and topic two. Okay, in quiz one, it's going to be um, topic one and topic two. Where was I then? Okay, so we're moving. Yeah, darling. Okay, hold on. Give me a second. Let me adjust my volume. It sounds. Why is it? Come on. Where's the volume? Okay, there you go.
Yes. When is the midterm?
Midterm. I can't exactly. I can't exactly pinpoint the date because the midterm currently we are in topic two currently, right? And we'll have to finish topic two, and then it will be quiz one. And after topic three, right? The midterm will be on after we complete topic three. Okay, so that will most likely, I don't know, I can't, most likely uh, this weekend, right? It will have to be this weekend because then that means quiz one will have to be somewhere in the middle of this week, and then midterm this weekend, and then we'll have only 1 week left. So during that week, we will have quiz two, and then the final, the last weekend, third weekend, then the final. So let's see. I mean, it depends on how much progress we can make, and of course, um, if everything goes by schedule, think about it. I'm gonna, and a lot of topic three was already covered while basic concepts of topic three was covered in while we were doing in topic one. Hopefully by schedule, if it goes all by schedule, this one will be, I mean, this is, you see, this is these are the January 12th is the release date of the last video, January 12th. But that's 1 day ahead of our 1 day ahead because I'm always releasing it 1 day ahead so that you can uh, uh, study, the pre-assigned readings. Like, so that means, officially it's gonna be, third topic will be officially over on Thursday the 13th. So yeah, then this weekend, right? Weekend of Friday 14th through 16th will be the good time for the midterm. Okay, if all goes as scheduled. So you have to be super diligent, right? You have to realize that winter session is just 3 weeks, right? And every day is like 1 week, right? Every day is 3 hours. That's, although it is, technically 2 hour 30 minutes, but it's almost 3 hours contents, right? That is, and that's 1 week during the regular semester, right? So it's everything is very, condensed. Everything has to be condensed. Uh, so you have to really stay focused, stay sharp, very sharp. All righty. So topic 2, right? And if you have downloaded topic 2, and I also want to make sure that everyone studied well the main lecture videos about the yield curve, because during the collaborate session, we don't have time to discuss the rationale, the reasoning behind it, why it shows, why when there is anticipation, recession anticipated, why yield curve exhibits inverted pattern, and that reasoning, it's a logical reasoning, and that part it is covered in the main lecture videos. And don't forget, I've been telling you over and over, collaborate session is only a reflection, a review, not the main lecture. So don't try to rely on the collaborate session. You got to study the main lecture videos. Okay. Now, so with that being said, let me uh, all right. So moving on. Now, so the financial statements are basically referring to four statements that the businesses must run and okay, business must keep a full financial statement. So I guess I'll have to open a new one. All right. So financial statements refers to four statements. First one is income statement. Now the full name, actually the full name is income and expenses statement, but we just call it income statement. Second, sometimes they call it P&L statement. They use slash or and or slash P&Ls. Why? Now the second statement is balance sheet. What's going on? Oh, it's pressing undo accidentally. No. Third one is cash flow. Cash flow statement. Fourth one is retained earnings statement. Retained earnings. I'm going to just omit the word statement because it's totally, redundant. We're talking about financial statements. So income statement, I'm not going to statement. I'm not going to use that word. I will omit it because it's obvious. Now, these are the fundamentals, the fundamental sources, data source. These are the fundamental data source to understand how the business is doing, right? So analyzing these statements statements is called fundamental analysis, right? Fundamental analysis. And when we say fundamentals, right, that term is very important because they would always say, look at the fundamentals. And what's the fundamental? I mean, the word fundamental, everybody, most people would try to define everything verbally. But verbal definition is always fleeting. It's transitory. It's really transient. It's fleeting. It just disappears. And it's not going to be the same. You cannot exactly reproduce the same verbal definition every time. Of course, if you memorize it, you can. But rote memory is not rote memory is not necessarily the point we are driving at. Rote memory is useless. It's not completely useless, but what is important is your reasoning about it. Reasoning. If you have a solid reasoning, right, you can always nail everything without wasting time by trying to unnecessarily cling to words, right? Sometimes we fumble with words because we're not sure if it is the most efficient and effective way of defining anything, because there is always a better way to express it. There is always, you can always paraphrase it rephrase it, and improve it. So verbal definition is not infallible, but whereas mathematical definition is infallible and it's indisputable, and there's no argument. There can be no argument about it. And I'm going to show you the examples. So when we say fundamentals, it's not words, but it's based on the data and the rationale, the reasoning behind it. So in fnb100, I mean, although there are 4 statements, these two won't be discussed in this class, but these two will be discussed in FNB 230. Okay, because relatively these two are more fundamental. In other words, these two are really primary data. It's the primary initial data, really, primary initial data. Of course, the data in income statement and balance sheet also come from journals and ledgers, but those are raw entry of data, and so you can say, well, if we really want to get to primary data source, then we'll have to go to the ledger and journal, but those are not organized. Those are like the figures just jotted in as they occur, not fully compiled data, compiled data. As far as the compiled data are concerned, income statement and balance sheet are initial data source. They are fully compiled. Okay, and then as opposed to that, cash flow statement are sort of like secondary data. It's the result of analysis. It's the result of analysis of income statement and balance sheet. Okay, so it's like more like a meta-analysis of income and balance sheet. So, and retained earnings, it's not that difficult. It's just only, reprocessing, the result of the balance sheet. So it's not a difficult thing. But most of all, because income statement and balance sheet are the initial data source, we're gonna only talk about income and balance sheet. But why do we talk about this at this point? Well, it's because, think about it. Our topic, the first topic was ROI, return on investment. And actually, we looked at it from the macroeconomic perspective. Macroeconomic perspective. In other words, of course, we defined a very basic concept of return on investment, holding period return, and annualized return. But we looked at it also from macroeconomic perspective. In other words, why? Remember, interest rate is the baseline of all return on investment, all returns, basically all returns. Nothing can be lower than the interest rate right? Especially the Fed funds rate. Fed funds rate. Of course, remember, Fed funds rate is the basis of all interest rates, but that also means, look, when the bank is lending, right? In other words, if you're borrowing, if you're the borrower, your rate will be higher than Fed funds rate. In other words, the bank's lending rate. Oh, let me do it this way. This will. Remember, Fed funds rate. When you borrow money from the bank, nothing can be lower than the Fed funds rate. I mean, all the rates will have to be, so that's lending rate. From the bank's perspective, right? All the lending rates are higher than the Fed funds rate. But if you are lending to the bank, in other words, when the bank is borrowing, it cannot be, it cannot be higher than the Fed funds rate, right? Because I explained why in the main lecture video, right? And that also means, so think about it. Nothing. If you put $10,000 into the bank, because it has to be lower than Fed funds rate. I just checked recently with the bank. What is the I asked them what's their CD rate. Yes, they don't pay even like, they pay like 0.5% APR. So CDs, so savings, it won't be even 0.1% savings, right? So think about it. Nobody will be, if you're willing to take a risk. I mean, who's going to be happy with like 0.1% APR, right? And the Fed funds rate has been between 0 and 0.25, right? Fed funds rate was between 0 and 0.25. And they say from March they will raise, and they will raise, at least like 3 times during 2022. That might bring it near. And normally when they raise it by 0.25. So if they raise it by 0.25 each time, by the end of 2022, it's going to be 1%. That means Fed funds rate will be 1%. Maybe they will raise more than that. Maybe they will bring it to like 1.25 or 1.5. But still, it's gonna affect the economy a lot. Okay, the first reason for raising the interest rate is to cool off the inflation, right? To cool off the inflation. But anyway, currently, because they haven't raised the interest rate yet, if you have $10,000, this is CD, and this is a savings account. some of you may just, okay, what can I do? If maybe I'll just put it into the CD and at least, this is the best I can do now. I mean, some of you may just, settle for that, but some of you will not be happy with this low interest rate. So what do? You will put it in you'll put it into stocks. You'll put it into stocks, and of course, then there is no guarantee. I mean, stocks have expected returns. Expected returns are basically, expected returns are like geometric average of the past returns. And depending on I would say on average, the expected return on the market has been at least around 10%. This is just, I'll have to check. I haven't checked it recently, but annually, at least S&P 500 has grown by more than 10% as far as let me just quickly check, right? Instead of just, oh, the market's going down again today. But this is ridiculous. Why? Because it's not as if the Fed's announcement about the interest rate hike has been unexpected. No, it's been expected already, for quite a good, deal of time, and this is almost like an overreaction. But anyway, GSPC, that's Standard and Poor's 500, dropped 1.69%. My portfolio is being plummeted, being pummeled.
It just means everything's on sale, so stock up. It'll go back up.
Yeah. I mean, once it is, oversold, then it will. It's a good, once it is oversold, most of the assets will be undervalued,
right?
And then it will, rebound. But let me show you. Let me try. Okay. So 1 year. Let's do 1 year. 5 years. And monthly. So think about it. That's March, January 2020, it was let me try December. This is monthly data. So S&P 500 in December 2019 was 3,230.78. And December, what did I? And December, end of December 21. 4598.13. Now, it's not a difficult thing, you know, we can simply the annual growth, just the annual growth, 4598.13 minus 3230 divided by 3230.78. 42%. Look, of course, this is just 1 year. But over the last, you know, we can take the average of the last 5 years, right? And of course, the climb is very steep. I mean, this is over the last 5 years, right? Because I selected, you know, 5-year time frame. But if I select maximum timeline, maximum, and then monthly, you see when, you know, when it happened, you know, to take off. I remember 1992, this was the start of the takeoff, actually. Prior to that, they were relatively, S&P 500 was relatively very tamed. And 92, from around 92, 95, 94, 95, because then it took off like this. And then we can tell already when this was. This was, you know, the bottom of the financial crisis, right? March 2000, you know, that was a big dip. There was a slight recession, early 2000s, early 2000s. But then since then, right, look at this steep climb, really, you know. So just from 2009 all the way to, I mean, if I take average of 2009 through 2019, those 10 years, or 2020, yeah, the growth, average growth rate of the market would have been, you know, like anywhere between 30 to 40%. But, you know, look, so that means on average, I mean, you can make a very bad investment decision, but, you know, S&P, you don't have to, if you have, let's say, $10,000, and S&P 500, let's say just to be conservative, S&P 500 has been growing at least at around 25% a year, you know, even if I take very conservative position in this. So think about it. You don't like, you know, this mediocre, you know, 0.1% on savings account or 0.5% on CD. You could have put that $10,000 into index fund, right? Or S&P 500 index fund, or ETF, exchange traded funds, but I'm going to talk about it. Like index fund and ETFs are very similar, but it's like, you know, they will take your money and it will, they will put it into their portfolio, and their portfolio consists of exactly the same stocks in S&P 500 in same proportion. Okay, S&P 500 is a weighted average. You understand? You should all know weighted average. Why? Dow Jones is a simple average. Dow Jones is a simple average, but S&P 500 is weighted average. Why? Because these 500 companies, their market capitalization, in other words, the total value of their shares in the market, total value of their shares, the market value of their total number of their shares are different. You cannot just add them, these 500 stocks, you cannot just add them up, stock price, each share price by share price, you cannot just add them up and divide it by 500 because their proportions are different. Think about it. GM is a huge company. Their market capitalization is also huge, right? And Apple and Microsoft, recently Google, was it? Three companies hit $3 trillion, I believe. Apple hit 3 trillion. Microsoft already hit 3 trillion, I believe, already before. And then Google, not sure what, but at least like 2 to 3 companies have hit $3 trillion market capitalization. That means the market value of all the shares outstanding, their shares outstanding, are total value of that, market value of that is $3 trillion. Now, $3 trillion is the size of British economy. Okay? So you cannot use simple average because their market valuations are all different. I mean, GM used to be, one of these. But think about it. Even Apple and Microsoft, their weight in the market is far greater than some smaller companies, right? So that's why it is weighted average. Now, so that means these index funds are holding these 500 shares also exactly in same proportion as the S&P 500, as the weight proportion of these stocks in S&P 500. These 500 companies are, think about it. In the US, how many companies are there? There are like tens of thousands of businesses. And how many companies are listed in the stock market? In the stock market, there are at least like 5,000 companies listed in the stock market. Oh, more than 5,000. Well, how do I know 5,000? Because the largest index is Russell 5,000. Russell 5,000. Okay? So even Russell 5,000, those 5,000 would not be enough to include all the companies listed in the stock market. So S&P 500 represents 500 biggest companies representing each industry, right? So if you put your $10,000 in S&P 500 index fund or ETF, you would have made like 25% on average. I mean, last year you would have made 40%, right? So this is why, think about it. The lowest return you can get from by investing your money, lowest return is always the interest rate. okay, bank interest rate like CD, and or something better, Treasury. You can get better risk-free return from Treasury, but still Treasury would give you only like 1.75 at best. So then the answer is, obvious. You put your money in the stocks, but to stay safe, you would put it into a index fund or ETF. But again, um, what S&P 500 did over the last year, this is ex post. In other words, we're into 2022, and we can look back. We can look back at 2021, and we can safely say if you have persisted, didn't sell, if you didn't sell, if you had persisted, then you would have made 40%. But during 2021, you wouldn't know. You may have sold, right? You may have sold, at the slightest dip, you may have sold. So the point is, why are we talking about financial statements? Because financial statements, by looking at the financial statements, we are looking at not only we're trying to look at the return on investment from company's perspective. Okay, we're trying to look at return on investment from the microeconomic perspective. In other words, not from a macroeconomic perspective. I mean, macroeconomic perspective, yeah, the baseline of old interest rates is Treasury, return on the Treasury, which is risk-free return, or bank interest rate. But when you are not happy with the bank interest rate, you will need to put your money into the stocks. Then let's see how the companies. You don't have to put your money into individual stocks. You could probably do better by putting your money into index fund or ETF. But we need to understand how the companies would evaluate their return on investment, and what is the data source, right, for that. In other words, the fundamentals of the business, and that is that's the main reason we are trying to look into the financial statements. Any questions? I heard some microphones clicking. Any questions so far? Any questions?
No questions. I was just reflecting earlier when you mentioned like the Russell 5000 and all that, and my understanding is that here in the United States right now we have about 3,900 publicly traded companies based in the U.S. There's the Russell 2000. There's the Wilshire 5000.
Yeah. That's Wilshire 5000.
Right. Well, we used to have 5,000 publicly traded companies up until the dot-com bust, and then fast forward, that's not the case with mergers and acquisitions and so forth. So that's one of the reasons why I'm a consumer of Barron's and Investor Business Daily and etc. But I don't see Wilshire 5000 referenced all that much, because there are not 5,000 publicly traded companies based here. That's not to say that we don't have access to overseas companies that we could trade. So there's certainly more than 3,900 companies that we have access to. But just to orient ourselves, because that number is always changing too. There's last year was pretty good. We had a large number of IPOs, initial public offerings, so there was new companies available to trade with. So I think it's a good sign that that number of 3,900 is increasing.
But it's always in flux. It's always in flux.
Yeah.
Good point. Good point, Stephen. When I said Russell 5000, I was actually referring to Wilshire 5000. Right. But
no, it's I know but I haven't heard that in a while. Yeah.
Yeah, and definitely, 3,900. There's definitely, yeah, at least that means at least 3,900 companies, publicly traded, right? But yeah, there used to be Wilshire 5,000 index, but I just I was making a reference to the number of stocks that are
Right, right.
publicly traded in the U.S. market. So I mean 5,000 was like a approximation, right?
Yeah, and it's trivial, really, but yeah,
Right,
I
right,
understand.
right. Okay, well, it's a good point anyway. So yeah, Stephen, I'm going to give you a zero point 0.5 for that, contribution. You made a good point. Today is January 10th, and Stephen, you got zero point 0.5 for that reference. All righty. So let's then, without further ado, uh, uh, let's go straight to my file is all, there's a lot of scribble on my file. I'm going to delete this, but you will have a very clean file, I believe. If you download it, it must be a clean file. So let's get this ready. And it's 12:55 now. So I think it's a good time to take a break. So let's take a 10-minute break and come back at 1:05. Okay? Come back at 1:05. All righty. So let's take a 10-minute. All right, we're back. We're back. How, from the company's perspective, right? How do we measure return on investment? I mean, basically, it's the same concept, same thing. But from the company's perspective, the most direct way of measuring their return on investment based on the financial statement would be return on equity and return on assets. Okay, return on equity and return on assets. We're gonna talk more about it later, but for now, let's move on to let's switch to our Excel file. Okay, I have deleted all the scribbles during the, do you all have this file in front of you? Do you have it all in front of you?
It's
Yes.
open on my screen.
Okay, good, good. And then is it clean or is there a scribble? Is it clean?
There's no writing.
Okay, good, good. It has to be a clean. I mean, scribble was my that was my old file, because I had, a lot of I used it for classes in the fall, summer, and spring, and okay. So once you have that open in front of you, let's go to the income statement first. And I also want you to have I want there to be nothing in these highlighted cells. Are those highlighted cells blank or are they filled? Those highlighted cells in your file, are they blank?
Filled.
It's filled? Okay, then please delete all the highlighted cells. Please delete all the highlighted cells. Okay, you got to start with the only the highlighted cells. Okay, so let's go to column I. We'll start with the income statement. Now, actually, the full name is income and expenses statement. Income and expenses statement, also called P&L statement. And I told you previously here in the whiteboard, income statement is also called P&L. What does P&L stand for? What do you think P&L?
Profit and loss.
Profit and loss. Yeah, profit and loss statement. Yes. Who was that? Yang?
Yes.
Okay, was it so? Okay, Yang. I'll give you another 0.5 for that. Now, from the name P&L statement, it's quite obvious why, what the income statement is trying to say. Some people, some people confuse, even after taking this course, and also some of you may have taken accounting 100. Was it 100 or 102 or 101 or but even after taking finance 100 or accounting 101, they get confused, they can't tell the difference between the income statement and balance sheet. Okay, and they just, they tend to presume that all financial statements are about profit. No, not all the financial statements are about profit. Income statement is about profit. Okay, the goal of the income statement is to describe the process that leads to profit. It could be loss, right? Not every company can make profit all the time, but loss is negative profit, right? Loss is simply negative profit, right? So goal of the income statement is definitely about profit, but the goal of the balance sheet is not about profit, right? So you have to get this straight, and you have to instill this in your mind. The goal of the balance sheet is not about profit, but about the capital structure. Okay, capital structure. So get that straight, get it right in your, instill it in your mind from now on. And when they say P&L statement, when they call income statement P&L, it's just the result. They're just focusing at the result, not the process. But we will be focusing more on the process because that's more important, right? So first of all, from the name income and expenses statement, we can tell it consists of two major components. Okay, two major components, which are income and expenses. Oops, why suddenly the color has changed? Two major components are income and expenses. Now, roughly, we know if you subtract expenses from income, then that should be profit, right? That should be profit. Isn't it right? You subtract expenses from income, it should be profit. But then we should be careful with the term income and profit because, yeah, it's profit roughly, but it's called actually operating profit or operating income. Now here's something that could be quite or something that's quite confusing, because in accounting they use the term income and profit as if they are interchangeable. But that's not true, actually. You don't call this one profit. Okay, there's a big difference between profit and income. What I'm saying is, you don't call this profit. This is not profit. Okay, and here pi is the symbol for profit in microeconomics. Okay, the symbols can take on different meanings depending on the context. In macroeconomic context, pi is usually used. Pi is the symbol to represent inflation, but in microeconomics context, it's the symbol for profit. Okay. So now this can be called profit. I mean, if you subtract expenses from income, it can be called profit. but income is not profit. The reason I'm saying that is it's called operating profit, but also called operating income. It goes by many different names. So I'm going to use slash operating income slash also EBIT. Okay. Now, EBIT is the terminology that I like very much, but operating income, I'm not feeling very comfortable about it because income is gross income. Gross income before subtracting anything. I mean, that's called income. But at this level, if you call that income, after subtracting expenses, if you call this income, it's like annulling. It's like nullifying subtracting expenses. I mean, you have subtracted expenses, then you should be called something else. But even after subtracting expenses, if it is still called income, then it's like voiding, null and voiding what you just did, right? So I don't like to use the term income here, right? I don't want to use the term income here. The better term is operating profit or EBIT. Okay. Now, but that's not net profit yet. Okay. To have net profit, you will have to subtract to get to net profit. You'll have to subtract interest, right? Interest payment, interest expenses. Why interest? Because we are talking about a firm, and a business will have debt. Either they have sold bond in the bond market, or they have they have taken out a loan from the bank. Either way, they will have debt, and debt must be serviced, meaning there is a interest obligation on the debt. So you subtract interest, and then once you subtract interest, and then you will have to subtract taxes. I mean, but no, let's think about it. Once you subtract interest from operating profit, then that's the income left to pay taxes, right? So the name here will be taxable income. But the better term is EBT. Now think about it. This was EBIT, right? I'm talking about this. This was EBIT, right? From EBIT, interest is gone. So then I must be dropped out. Hence, EBT. So then from taxable income, what do you need to do? You will have to subtract taxes. Okay. After subtracting taxes, then it is called net profit. Again, It's called net income too. And that's why this is something I don't like about accounting, because they are not, but there's a good reason for that. And then another way to call it is EAT. EAT, okay? Now let's think about it. This is the big picture. You have to remember that this is the big picture. Minor line items, it can always be adjusted later. Minor line items, right? So you shouldn't be distracted by minor line items, but focus on the big picture. But if you focus on the big picture, first, let's take a look at the income first, okay? Give me a second. I forgot something. I left something on. Okay, second. Give me a second. All right. Now, so now let's think about where what's the source of income. Now, there are two sources of income, if you think about it. The primary source of income is sales revenue, right? Sales revenue. Goes without saying. Primary source of income is sales revenue. Because any company, every company, and any company, they must sell something, right? That's the source of their revenue. And what is revenue? We must define revenue. Would anyone do the honors? Would anyone define revenue for me? What is revenue? We know what is revenue, right? Obviously,
Revenue is price times quantity sold.
Yeah. Who was that?
Randy.
Randy, great. Randy, yeah, you got 0.5 for that. Randy, you certainly did your homework, right?
Yeah.
When I ask this question, a lot of students try to come up with verbal definition. And I told you, verbal definition is fleeting. It's transitory. It's really transient. I mean, what I'm saying is it's fleeting. It doesn't stick. It just goes away. And you cannot reproduce it verbally exactly the same way. But we already know. We know we have the idea about revenue. We have the idea of revenue, right? Anybody can say, well, that's what you receive for selling something. I mean, what you receive as payment for selling something. Yeah. We know already, even vaguely, right? We know what revenue is, but to be exact, we have to, and to make it indisputable and infallible, we have to define it always mathematically. Revenue is price times quantity sold. Price times quantity sold, right? Now, then some people might say, um, if we are selling, I mean, if you are selling only one thing, then it's price times quantity sold. But if you are selling like, 10 different goods, 10 different goods, they will all have different price, right? Different prices. Then what do? Well, we can extend it. In other words, still it doesn't make any difference if we have n number of products that we sell, where I runs from 1 through n. Okay, the pi times qi. You already know what this means. It was p1 times q1 plus p2 times q2 plus p2 times p3 times q3, right? We can extend it to n, right? Any level of n, but eventually it still doesn't change the fact that revenue is price times quantity, and revenue is the primary source of income, always. And then there is secondary source of income. A secondary source of income is also called passive income. Passive income, such as now, revenue is the result of your active activity, right, of selling. I mean, you're not just waiting. Some people, if you're a small store, if you have a small store, right, you may be just, waiting for the customers to come by. But still, even if that's the case, you're not actively promoting your business or whatever. Still, there is an act of sale, and which involves, acquisition of merchandise, first of all, right? If you're a manufacturer, it already has involved the activity of production, right? But then, so still, revenue is the result of active sale, right? Activity. But passive income is the income that you don't really actively engage, income that is derived from something that you don't actively engage in. Passive income is something like investment income. Investment income. Let me just. Or I'll just use and or. Something like rental income, right? Think about it. When you put your money in a CD, $10,000. Suppose you put $10,000 in the CD. That 0.5% interest rate, right? That's going to be the return on your investment, and that happens, passively, right? And as a business, right? If you're a business, right, you will have a lot of your retained earnings from the profit put into some stock market and put into some stocks, right? And then that return on your investment is really the result of the passive activity. Passive activity. What's the word? Passive management. Passive management, right? So most business, of course, revenue, primary source of income. Now, let's think about the expenses. Also, there are two sources of expenses. Primary source of expense is called CGS. And the secondary source of expense is called OPEX, or operating expenses. Now, CGS is the accounting's terminology, but this is called, also direct cost. Direct cost. Operating expenses is called indirect cost. Indirect. And CGS stands for cost of goods sold. And in microeconomics, this is actually called total variable cost. Total variable cost. Okay. Operating expenses in microeconomics is called, it's not exactly the same, but it's roughly equivalent to total fixed cost. Okay. Now then, the question is, now cost of goods sold is, think about it. You have a business. Your business is like, let's say your company is Best Buy, okay? And we all know Best Buy is electronics, consumer electronics, retail. And so in your store, right, Best Buy may have, 1,000 units of Dell computer, right? Now let's think about it. So I'm going to have to move this to assume Best Buy. And Best Buy, as we all know, consumer electronics, so they have Dell Model X, right? And they have 1,000 of them. Okay. And of course, assuming that, and the price per each is, let's say, 500, right? And we can easily tell, oh, well, then if they sell all these 1,000 units, if they are able to sell all these 1,000 units, then they will not make, actually, so we'll have to define the terminologies here. We can tell their revenue is 500K. We can tell their revenue is 500K. And this $500 is the Dell Best Buy's price. And it's certainly not Dell's price, right? Because Best Buy must have bought it from Dell. And when they bought it from Dell, let's say they paid, $300. And so Dell's price, then, think about it. Dell's price is, that's called manufacturer's price, or ex-factory price. Okay, the same Dell Model X, ex-factory. Best Buy won't sell it for $300. I mean, nobody is stupid enough to sell it at the cost. This is the per unit cost for Best Buy, isn't it right? Per unit cost for Best Buy. But it is also selling price for Dell, right? For the manufacturer, that's the selling price. But anyway, the point is, since Dell, Best Buy purchased 1,000 units of this Model X from Dell for $300. The total of that is 300K. Isn't that right? The total of that is 300K. And then the 300K is then what? It is the total variable cost or direct cost or cost of goods sold for Dell, right? If they sold all of them, of course, right? That's why cost of goods sold. Okay, that's why CGS. Now, when they sold 1,000 units, right? When Best Buy sold all 1,000 units, when Best Buy sold all 1,000 units, can we say they made 500K? Their revenue is 500K. But is it correct to say that they made 500K? Anyone?
No,
No. Why not?
because
Why not?
that is not a net value.
Oh, okay, you get the concept, you get the idea. That's not the net value. In other words, that's not the profit. Isn't that right? So here's something we just okay, was that EN? Yeah,
Yeah.
okay, I'm giving you another 0.5 for that answer. We just language is in part habit. Spoken language, especially spoken language, is part of our just habitual practice, right? So we often say, I made money, or I made 500K. But what does that exactly mean? I mean, first of all, let's define this. When they say, what is the goal of any business? What is the goal of the business? What is the goal of the business?
Make profit.
To make profit, yes.
Maximum profit.
Yeah. Someone said make profit. So who was that?
Randy.
Okay, Randy. And who said maximize?
Yeah.
Is that Ian? So
Yes.
complete the sentence. Maximize.
Maximize the profits is the
Yes,
main goal of
maximize the profit. Okay, so Ian, I will give you another 0.5. Yeah, Randy, it wasn't entirely wrong, but I'll give you 0.25. Yeah, the goal of the business is to maximize profit, right? Make profit. Yeah, it's to make profit, but any level of profit? No, they want to make maximum profit, right? Not any level of profit. In other words, the sometimes when I ask these questions, most of the times the students say to make money. But what does it mean to make money? Did we make money in this case, in Dell's case? Did we make money in Dell's case? I mean, for example, Dell, if they sold it for, you remember they bought it from Dell. They bought it from Dell for $300 each unit, and if they sold it for $300, if they sold it for $300, did they make any money? Of course not. They didn't make any money. If they sold it for $300, 1,000 units, that's 300K. Then that exactly cancels out, right? In other words, that's the cost they paid, right? They paid $300 to Dell, and they're selling it for 300. They got $300K for that. They're not making any money, right? So in other words, we know making money means making profit, right? But we better make it very clear. Instead of just vaguely saying making money, we should say make profit, but any level of profit. So suppose we sold every unit for 301, right? We sold every unit at $301. Did we make profit?
Yes.
Is everyone following?
Just 1K for profit.
Yeah, right. 1K, we made 1K for profit, right? And that means, $1 per each unit. $1 per each unit. Okay, we made profit, but is this acceptable? I mean, it's better than not. It's better than none, right? It's better than none. Was that Ian?
Yes.
Okay, so I'm giving you another 0.5. I mean, this is nothing difficult. It's just very elementary, and it's just logic. It's just logic. Nothing, nothing mathematical. It's just logic. But I'm asking you these questions for you to earn some points. But then if you refuse to take that opportunity, then I have no other choice. Look, if you make $1 profit per unit, it's better than none, but this is not the desirable level. What's the desirable level? Maximum. But what is maximum? If we can sell it for 500, I mean, look, if we raise price, first of all, you got to understand, if we raise price, the demand will go down. Quantity demanded will go down. Right? You understand? So there's a limit to how much we can raise, right? And you have to stay also competitive. So the point is like this. Let me use. We all understand the demand curve is downward sloping. So if our price, let's say it is 300, if our price is 300, right? And then we can sell 1,000. If you raise the price to 400, let's see, demand will drop. Let's say at 400, the demand will be like 600. And if we raise price to 500, demand could be something like 400. So then what is our revenue? The revenue will be this is the revenue. This area represents revenue, isn't that right? If you sell it for 300, 1,000 units, so the revenue will be revenue 1. Revenue is the area of this rectangle, isn't it right? It's going to be 300K. Suppose, and when we raise price to 400, right? We can sell only 600. So in this case, the revenue will be 400 times 600, 240K, right? If we raise the price to 500, demand will drop to 400. Then revenue 3 will be 200K. So in other words, we cannot raise, price indefinitely. But this is just an example I just cooked up, so it doesn't always end up like this. But in this example, the revenue was the maximum when price was 300. But let's say the demand is not this elastic, but demand was less elastic, then probably at some point, maybe when the price is 400, the price doesn't the demand doesn't drop that much. Let's say the demand is 800, right? It's not 600, but 800. But then the revenue 2 will be then, in that case, revenue 2 prime $320K. Now, if that's the case, then you would choose, right? You would choose $400, which would maximize your revenue, right? Of course, maximum revenue doesn't mean necessarily maximum profit. But at this point, we'll just assume they would coincide. So when we say maximize profit, right? That's basically, unless you're a nonprofit. Nonprofit's goal is not to maximize profit, but businesses are basically commerce, right? In any commercial business, right? In other words, in any for-profit business, right? The goal is to maximize profit, and to maximize profit, right? When we say, based on that concept, when we say make money, we should clearly understand that means making profit. Again, if we, so here in this example, let's assume there is no passive income. Assuming that there is no passive income, assuming $0 for passive income, right? Then the only source, the sole source of our income is the revenue. And from the revenue, and we assume that the we can sell all 1,000 units at $500. We'll assume that. And then we have our direct cost was $300 per unit, and we bought 1,000 units from Dell. So our CGS, or total variable cost, is 300K. Okay, here this brings us to the further breakdown. This brings us to the further breakdown of total variable cost. Why? Now let's think about it. Total variable cost. This is total variable cost. On the right. CGS, or total variable cost. But then, what is $300? What is $300? What is $300? Isn't $300 unit cost? I mean, there are.
No, it's the total cost.
No, $300.
Oh, yeah.
It's the unit cost, or it can be called, it can go by many names, unit cost or per unit cost, right? Per unit cost, or just unit cost, or is called average variable cost. Average variable cost. Okay, average. Now, why? Isn't total, when we have total, right? If you divide total by number of units, if you divide total by number of data points, right? Then what's it called?
Average.
It's called average. Yes, that's what the concept of average is. Right? It's simple average, right? In other words, if I collect all the individual heights of everyone in this class, right, and I sum everything, divide it by number of people in this class, and that's the average height. So the relationship between total and average is, if you divide total by average, then it's, if you divide total by numbers, then it's average. And then if you multiply average by numbers, then it's total. Isn't that right? So think about it. Total variable cost is, what did we do? Here, unit cost, or average variable cost, times the number, right? Times the number, right? 1,000, right? And that's total variable cost. Okay. Now here's the so this brings us to the parallel. I mean, what's the parallel? Our revenue is defined as price times quantity sold. Okay. Then total variable cost is defined as average variable cost times quantity sold. Isn't that right? Or unit cost times quantity sold. So if you think about it, this is exactly two sides of the same coin. Why? For every unit of this Model X you sell, price is 500 and unit cost is 300. Okay? So this difference is called gross profit. But I don't like to use the term gross profit, but we'll just call it gross profit for now. So think about it. Gross profit is $200 per unit. And if you sell 10 units, right? Revenue is 10,000. CGS, or total variable cost, is 30K, right? Revenue 50K when you sell 10 units. Revenue 5,000. I'm sorry. Revenue 5,000 if you sell 10 units. Total variable cost, or CGS, 3,000, right? The difference, 2,000. Of course, because it's 10 units. If you sell 100, right? So the same thing. In other words, revenue and TVC, revenue and total variable cost, are two sides of the same coin. They go hand in hand. In other words, revenue and CGS, revenue and cost of goods sold, go hand in hand. It's two sides of the same coin. Therefore, sometimes they also call CGS cost of revenue. CGS is also called cost of revenue. Make sense? Because it's the cost side of the revenue. CGS is exactly the cost side of the revenue. Hence, cost of revenue. Two sides of the same coin. Right? Make sense? And also, wow, it's already 2:05, 2:02. So I think it's a good time to take a break. Let's take a 10-minute break, okay, and come back at 10-minute break and come back at what 2:10. Let's come back at 2:10. Okay, let's take 2:10. Come back at. I thought we were still going on until 3 o'clock. Yeah. All righty. So let me just. All right, we're back. We're back. So now let's think about what. Let's think about what variable cost means. I mean, variable cost, it's called total variable cost. Direct cost is called total variable cost, which is also called CGS, cost of goods sold. And variable means, people generally easily understand what CGS is, cost of goods sold, because it's literally, if you sold 1,000 units of Model X, right, to Best Buy, the cost is 300, unit cost is 300. So 300 times 1,000 units, that's exactly cost of goods sold, right? And it's called, but why is it called variable cost? Why is it called variable cost? Now, think about it. The reason it is called variable cost is that this amount, right, this 300K, currently this is the CGS, and this is the total direct cost. But this 300K is, it can change. Isn't that right? Vary means change. This total amount changes. Changes with what? Changes with the quantity sold, right? And that means, this per unit cost is given. Unit cost is assumed, given. Of course, unit cost can change over time. I mean, during the time when production cost goes down, unit cost will go down. When things get cheaper, and I've been telling you, the production cost of the price of computers went down drastically compared to early 1990s. Because why? Because the chips became cheaper to produce. I mean, there is benefit of scale, economies of scale, and it became possible with the technology, technological breakthrough. In the early 1990s, you could cut out only one chip out of the whole wafer, silicon wafer. But as over time, it doubled. Every 6 months, it doubled. The capacity doubled. So that means more capacity for each microchip, right? In the early days, like early 1990s, one microchip had the capacity of that was like 240K, 60K, 120K, 240K, 480K. That determined the speed of the capacity and the speed of the processor. But this capacity doubled every 6 months, almost every 6 months. Now we don't find any processor, any chip whose capacity is below some 4 gigabytes, right? So what does that mean? The technological breakthrough brought the cost of manufacturing these chips And together with that, the price of the computers went down. So for example, those input costs go down, then this AVC or unit cost can go down. But that happens over time, not in a single point in time. In a single point in time, this cost is fixed, is constant. And of course, when you acquire 1,000 units, your Best Buy, always keep in mind, your Best Buy, and as a retailer, you buy computers from manufacturer like Dell. And when you buy this Model X, you buy the bulk, like 1,000 units. And then the pricing for that bulk is fixed. I mean, Best Buy won't give different price for 100 units for the first 100 units and different price for the second 100 units. No, it's not going to be like that. It's going to be $300 for all 1,000 units. Okay, so the total amount would depend, the total amount varies depending on the quantity sold, okay, or the quantity sold by the manufacturer, right? So that's why it's called variable cost. Okay, that's why it's called variable cost. And also then think about it. This is the case of Best Buy. I mean, from Best Buy's perspective, yes, that's the case. But from Dell's perspective, the manufacturer's perspective, this 300 is their selling price. So 300K is their revenue, right? From the manufacturer's perspective. And then manufacturer's cost would be something less than that. Manufacturer's cost maybe 200, right? And then this difference between this 200 and 300 is called markup, right? If Dell's cost per unit is 200, the difference is called markup. But you know, from Dell's perspective, even if we suppose this is Dell's cost, I mean Dell's manufacturing cost, the reason it is called direct cost is, where do you think this 300 comes from? Think about it. For
The
Dell.
input.
Yeah, exactly. Who was that? Ian?
Yeah.
Yeah, you're almost single-handedly answering all the questions. What about other people? You got another 0.5 for that. Yes, from the manufacturer's perspective, it comes from the input. And what's the if you look at it from the manufacturer's perspective, right? It makes sense why it is called direct cost, because from the that 300 must be the result of direct inputs, right? Direct inputs of production, inputs that go into production. So and what are the direct inputs? What are the inputs of production? It's also called factors of production. What are the inputs of production? Anyone? This is actually microeconomics. What are the inputs of production?
Labor, land,
Okay,
equipment.
labor, equipment. Okay, yeah, actually, it's capital, labor, and raw
Raw
material
materials.
or natural resources, right? So, yeah, labor, definitely. Labor goes in, there's nothing that, I mean, a fully automated, even a fully automated plant would require some labor. What kind of labor? Someone who is sitting behind the control tower, right? Someone who is sitting behind the workstation. I mean, even if the plant is fully automated, there must be someone who controls the whole system, sitting behind the fully computerized system. Capital, that means physical capital. In other words, plant and equipment. Plant and equipment. Labor, we know it's manpower, right? Natural resources or raw material. Yeah, to make computer, we need the raw materials. You need chips, CPU, the processor. A flat panel screen. Keyboard and things like that. So, excuse me. These are the factors of production, what they call factors of production in microeconomics. Okay, so if it takes $300 to build 1 unit of this Model X, then that $300 is mostly, probably about 70% of that $300 would be labor, right? Capital can be spread over a large scale of production. It could be like, only about 20% of it, right? And then natural resources, it could be about 10% of those $300. But anyway, this is why it is called the direct cost, because it's the cost of the direct inputs, right? Direct inputs of production. And then I said second source of expenses is operating expenses, OPEX. It's also called indirect cost or fixed cost. And what does that mean? What does fixed cost mean? That means this cost doesn't change. What is the variable cost? Variable cost is a cost that changes with the production level. As the output goes up, right? Production level goes up, right? The more units you produce, and the more units you sell, variable cost will go up. It goes up, and the fewer units you produce, fewer units you sell, the variable cost goes down. Because obviously, think about it, the less you make, the less you produce, right? The less input is needed, right? The less input is needed. The more you produce, the more input is needed. Therefore, variable cost, it varies. But then fixed cost doesn't depend on the production level, right? Fixed cost doesn't depend on the production level. So hence it is called fixed, right? It has nothing to do with the production level. No matter how many units you produce, no matter how few units you produce, this doesn't change. And in accounting, it's called operating expenses. And I said it's not exactly equal, but roughly equivalent, right? Everyone should recognize this symbol. That means roughly equivalent to, not exactly equal to. Why? Because the focus is a little different in microeconomics than the focus in the accounting. Because in microeconomics, fixed cost is mostly about initial investment. Oh no. Initial investment or sunk cost. Okay, that's the focus of microeconomics. But in accounting, the focus is more on day-to-day, literally day-to-day expenses, and it is relatively something like R&D expense, marketing expense, very minor line items. I'm gonna, for example, here, yeah, direct cost is directly related to production, right? Production level. Hence, it is called direct cost. That's another name for CGS. What is unrelated to production? Something like rent, utilities, salaries, depreciation, R&D expense, marketing. These are more related to operation. And still, think about it. They don't depend, they have nothing to do with the production level. Nothing to do with production level. Okay. But none of this is reflecting, none of this, maybe slightly depreciation is the only line item that's reflecting the sunk cost, initial investment, but it is really spread out across a long time horizon. So it's not directly reflecting the sunk cost. So that's the reason why operating expenses is not exactly the same thing as TFC, but roughly equivalent. Okay. Alrighty. So our time is up. Our time is up. So any questions so far? Any questions? Somebody wrote something here. Essentially, cost of manufacturing. Kyle, I'm not sure what you, it was 2:23 p.m. you posted, so you were referring to what? Operating expense? Cost of manufacturing. If you're saying cost of manufacturing, that's actually direct cost. Direct cost. Okay. All right. Any questions so far? Any questions? Any questions? All right. Okay. If you have no further questions, we'll call it a day. Have a great afternoon, and I will see you guys tomorrow. Okay?
All right. Thank you, sir.
You.
All righty.
Professor.
All righty. Have a great afternoon, everyone. Stephen, Kyle,
Thank
Kazuki,
you.
and Darlene. I will see you tomorrow at 12, okay?
Have a good day,
All righty.
Professor.
You too, Angel. All righty. So I'll stop sharing, stop recording, and sign out.